Letting property feels harder right now. It just does. And it's not just the interest rates, it's the tax stuff, the licensing, compliance, and rents flattening out a bit. It's all adding up. I've had quite a few messages from other experienced landlords asking, is it just me or do the numbers really not work anymore? And the truth is, it's not just you. It is tighter than it used to be. So in this video, I want to be really open about property investment right now in November 2025, why it feels tighter, what I look for before I even offer on a property, and how I usually structure my deals as BRRR rather than standard buy-to-lets. So let's start off with what has changed. Well, first, mortgage rates have come down a bit from their peak, so you can find the odd deal in the 3 to low 4s now depending on lender and setup. Most deals are still around 5%, and lenders are still stress testing around 7%, some a bit lower than that, but I always use 7% of my current numbers to keep it simple. Second, rents are still going up, but not at the mad pace that we saw a year or two ago. It's now more like a couple of percent year on year, so banking on big jumps to make a deal work is risky. Third, costs have gone up. Licensing, building control, decent trades, materials, it's all gone up. Fourth, there's tax. Section 24, that's the rule that stops you fully deducting mortgage interest if you're investing in your personal name, still bites unless you're buying through a limited company. And then fifth, and it's a hot topic right now, is the Renters' Rights Act, formerly known as the Renters' Reform Bill. It is now passed and become law on the 27th of October 2025, but nothing's changed just yet. The new rules aren't live. They'll get rolled out once the government announces the official start date, and it's probably going to be sometime in 2026. Still, I think it's smart to plan as if it is coming, because it is. I've done a totally separate video breaking down the Renters' Rights Act, and you can find the link up here. So yeah, letting is tighter, but don't think it's broken. It's just less forgiving. You've now got to treat it as a business, not just a side hustle. So what do I check when I'm looking for a buy-to-let property now? Well, say I'm looking for a property that's listed for 135k. Well, a 75% LTV, which is pretty standard for buy-to-let mortgages, would mean that I'd be borrowing 101k. And let's say the lenders want a stress of 7% and an interest cover ratio of 125%, which are pretty standard figures right now. That means that the minimum rent required to mortgage at 75% is about £740 a month to meet that criteria. So now knowing that, I'll check local comparisons for that property. If other rentals on the street or nearby for similar houses are only doing £700 a month, I usually move on from that property because the rent wouldn't support the mortgage I'd need at 75%. But if the comparisons are getting £750 to £800, then I'll look closer. But on top of that, I'm going to have to plug in all the boring bits, so arrangement fees, broker fees, legal costs, etc. If it still works overall, then great. But if not, I ask, is there anything I can do to push the rent or the valuation higher with a surface level refurb? So now we're into BRRR territory, which stands for buy, refurbish, rent and refinance. And it's pretty much all I do these days. Here's a real example from earlier this year that's been ticking along nicely. I purchased a property for 135k after a good negotiation. I spent about 12.5k on a surface level refurb, so nothing structural. It was more a clear out kitchen and bath renovation, flooring and paint. It was then revalued at 185k, which is a 50k value add, and then I refinanced that at 75% LTV, which gave me about 138k back. Then after all the fees, which I haven't really mentioned here, it left about 15k of my own money still in the deal. But it now rents for about £915 a month, and after the mortgage, the insurance, the maintenance and the letting costs, it's generating about £300 a month, which is roughly, based on the 15k that I've got left in, 24% ROI, and the property is being managed for me, so it's not bad at all really. And more importantly, it's repeatable. Now it's worth pointing out that this is not even including the capital growth of the property. So if you assume, say, 4% a year over the long term on 185k, that's just a nice bonus. Don't rely on that, but historically speaking, it should benefit me in the future. And this is exactly why I tend to go for BRRR. I'm going to be doing a refurb on a property anyway, because those are just the types of properties that I buy. So if I can lift the rent and the valuation and get a good chunk of my cash back out, it just makes sense. It's not a secret trick, but if I'm doing the work anyway, I'd rather structure it so there's a chance to recycle my cash. Sometimes it goes really well, like it has done in this example, but sometimes you're going to end up leaving more cash in than you'd hoped, and that will cut into your profit. But it's still better than doing the same work and leaving all your cash tied up until your fixed mortgage deal ends. So let's zoom back out for a second. Property in the UK in general tends to run in cycles. We've had boom years and we're now in a squeeze. It happens. But long-term, property's still got a solid track record. People still need to rent, and they'll pretty much always need to rent. Whether it's students, relocators, key workers, or families between places, the demand's still there, and I don't see that changing anytime soon. But like I just talked about, I don't want to rely on the capital growth to make me my money. If it happens, then great. But the deal needs to work today on the boring assumptions, ideally with a healthy ROI on the rental income alone. So I always go for a solid house with a sensible refurb, fair rent, great tenants, and that's enough buffer for me. And that's my overall plan. So to round off, here's my quick checklist. First, run the rent against the lender's stress rate. If it fails, just move on and find another property. Second, add the actual fees, not just the deposit, to any of the calculations you're doing. Third, see if a refurb actually improves rent and valuation. Fourth, run 2 valuations, a cautious one and a hopeful one. If the deal only works at the hopeful price, then don't do it. Fifth, if you're doing a refurb anyway, then try and structure it as a BRRR from the start, and hopefully you can pull most of your cash back out. So that wraps this video up. If you found it helpful, a like and subscribe really helps the channel. And if you're interested in more, then I'll put a video floating over here on what I do with 50k if I was starting again. And if you want the tools that I use for my investments, like my viewing checklist and my investment spreadsheet, they're linked in the description below and totally free. Thank you for watching, and I'll catch you in the next one.